Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
And welcome into the program. This is Navigating Retirement with Charleston's resource for a common sense approach to planning for our financial, investment, and retirement future. He is president and founder of the Coastal Financial Planning Group. Rick Durkee with us once again. Rick, welcome back.
Good morning, Peter, and good morning to our listeners joining us here on our podcast edition of Navigating Retirement. Appreciate you joining us today. Got a lot of good stuff to talk about again, as we do each and every week here.
Absolutely. And Rick, today on the program, going to be talking about how we measure performance as well as the emotions behind our investments, behind our money, and behind our performance. And Rick, emotions are important, obviously. They are powerful, but a lot of times money is not just math. It's very emotional. There's a mental and psychological component to our money. And more often than not, the emotions can lead to mistakes rather than being beneficial when it comes to our financial decisions.
Yeah, when we're looking at investing, oftentimes, we want to be factual with it. But emotions do get involved. But the factual part really is when you sit down and you say, this is a mix of fact and emotion. What do I want this pool of money to do for me? And how do I expect using it in the future? Now, these are emotional facts that go into that decision-making process as to what type of investments you want to go into and what your goals are with that money. Oftentimes, Peter, I see that people don't look at managing their money as a bucket approach where different pools of money are used for different purposes. So, but then if the emotions get involved, then we could be in trouble. We're making emotional decisions instead of logical decisions. And so let's talk about that today.
Yeah, if we have a purpose-driven planning and investment approach, oftentimes we can remove a little bit of the emotional aspect of the decision-making. Again, if you've got questions or concerns, I want to remind you before we get going that Rick Durkee does make his time available. Always happy to help. It is beneficial to have the assistance of an experienced, qualified financial professional. All you need to do is pick up the phone to be in touch. 800-491-6220. That's 800-491-6220. And perhaps with the guidance and holding you accountable, a qualified, experienced professional can help you get better results with your money. So Rick, let's get into it. 5 potentially costly emotional mistakes and how investors are driven to mistakes often by emotion. The first one on the list, impatience. And I know I suffer from this from time to time.
Impatience. It comes right after we decide to invest, and then we're like, man, we're not getting the returns on this we should be. Should we be at higher risk? Should we get some more higher potential rewards? What's going on? And then guess what? The market does what it does, and it drives the bus anyway, right?
Right.
So our emotions again can get in our way of making these type of decisions as to how much risk we take and what our expectations are for returns.
Dalbar is a financial institute that studies investment behavior. They are a leading investment research firm, and they do this study every year, the quantitative analysis of investment behavior or investor behavior. And they have found continuously and repeatedly throughout the 30 years of doing this that investors substantially, significantly underperform the market index, mostly driven by the emotional knee-jerk reaction decisions that we make.
Yeah, Peter, and that's exactly why at the Coastal Financial Planning Group, we found over the years that the people that we can help the most are the people that haven't experienced the returns that they expected. They got impatient. Maybe they had somebody else managing their money for them or giving them an idea or two as to how to invest. And it just didn't turn out the way they wanted to. So they became impatient. They came to see us. And then what we talk about when we meet with clients is let's have a process that's more rules-based. Let's make sure that we figure out with a plan what your expectations are, and then let's meet those expectations with a defined outcome of some sort by choosing the type of investments that we want to have in that plan to attain those goals, we can beat the impatience emotion and let the market do, as I said earlier, what it's going to do. And it's going to do that on its own. We don't have to try and push it. It'll do what it does on its own.
Yeah, we can't control it. But again, consider staying with the approach, defining a strategic planning approach, and then a experienced, qualified professional can certainly help hold you accountable, keep that discipline, help you build and maintain that investment plan. Pick up the phone, give Rick Durkee and the Coastal Financial Planning Group a call, 800-491-6220. Rick, how about overconfidence? And this seems to happen like when the market is reaching its all-time highs or going very well. But in those moments, we actually have more potential risk of loss, and yet we all feel euphoric and overconfident.
Look how good we're doing. Everything's going up, right? Yeah,
Right.
The S&P 500's hitting all-time highs. We get all this information, which really is somewhat misinformation because it doesn't pertain to our portfolio. We get the benchmark index reports. We see that the Dow's hitting its all-time highs, or that, bonds are expected to lose value because interest rates are at all-time lows right now, and interest rates will go up in the future. All this information is important. It does help us make decisions, but here's the problem. It doesn't apply to our individual goals, desires, and our portfolio's goals and desires for performance. So we have to fine tune that. We have to make sure it's specialized. And when it comes to overconfidence, I've seen this more times than not. People come to me and they say, well, yeah, I'm doing really good. Look, I got $1 million in my 401k. I've managed this thing for the last 20 years and we've done really well. Well, let's look back historically and let's really see what happened during that time. And was a lot of your gains contributions when times were going down low and we were doing dollar cost averaging and we were buying in at lower shares? Yes, that was a good plan during your accumulation years. Now we need to scale back the risk and also look at it from a standpoint of when we're planning on using that money. So don't let overconfidence get in the way and cause some mistakes that could definitely cost you some big money, because overconfidence happens right before that market starts tanking.
Sure. Yep. And when we think we know something, when we're following, chasing returns, or we've gotten that hot tip, that's another time when I think we've got overconfidence. But if you've seen the periodic table of investments, Rick, it sort of shows every asset class and over time how they cycle through from being the best performing to being the worst performing. The only constant there is that cash is usually somewhere in the middle. But if, for instance, in 2007, everybody was fond of international emerging market funds. That was sort of the darling of the financial world. The BRICS were going to really begin to come into their own. 2007, It was up nearly 40%. 2008, it was down more than 50%. So again, be wary of chasing returns and performance. Work with your qualified, experienced financial professional to select investments on a strategic planning approach with in-depth knowledge and research based on your situation and based on the financial world. What can help you achieve that, optimizing your portfolio for the specific purpose that you need that money for, right, Rick?
Yeah, that's true. That's true. And, we lead on to this next emotion here in a minute, Peter, and we talk about, how a lot of people were very proud of the fact that going back 2007, they said, I just got this feeling, it just was way overinflated. So I got out and I went to cash and I sat there. But then, fast forward to 2015, and they said, but I didn't know when to get back in. I was afraid.
When you're timing the market, Rick, you have to time it right twice to be right. You have to know when to get out and when to get back in. And doing both of those correctly is very hard to do. Even if you feel very proud and happy and feel like you timed the first decision correctly, you have not completed the process. And because you feel confident about the first decision, it might make you apprehensive about the second decision and then end up making it a mistake like what you just said. But Rick, it's not all or nothing. If we pulled our money out of the market before the dot-com bubble or before the 2007, 2008 collapse or before the coronavirus pandemic, we don't have to get all the way back in immediately. And again, timing the market, not the correct approach more often than not. This is not something you should be doing. But if we had that gut intuition, Rick, and pulled our money back out of the market, it does not mean we have to put all of it back in all at once. Maybe dollar cost averaging would be an approach to help overcome this fear.
Yeah, and they say, a lot of financial decisions, Peter, are based on two emotions, fear and greed, okay? So maybe we're getting greedy when we were overconfident and we were saying, let's throw some more money in there, the market's going up, and then all of a sudden it starts going down and we say, okay, we should get out now. So you get out in time, but then you don't know when to get back in, and that's that fear component of emotion. So we just wait too long to get back in the equities market. If you use a rules-based system where you're using defensive managed institutional investors, as we do at the Coastal Financial Planning Group, they're protecting their money for downside risk, or what we call drawdown in the equities markets, that measurement of an investment's performance from peak to trough, and when the market's going down. And as we saw 2 times in the last decade of 2000 to 2010, the US stock market is measured by the S&P 500, dropped 2 times 50% or more. So, but then those people, again, telling the story of the people that didn't know when to go back in. 2009, things hit the bottom, things started going back up, and there was an incredible bull market that we experienced all the way until this year, when the market finally dropped down and went south side.
Sure, and it happened so quick, Rick. I mean, the drop this year with the onset of COVID, maybe an extreme version of fear. I think a lot of people during COVID felt a sense of panic, the next emotion on our list here that we want to address. And good decisions are never made in moments of panic, Rick.
No, because then, no logic is involved in panic. We're not prepared. We didn't have a plan. A good example would be natural disasters and hurricanes and things like that. Did we have an exit strategy? Did we have, our hurricane preparedness kit ready? Did we have that exit plan to get out on the interstate, 2 days before and get inland? We can't panic, and we can't last minute panic. And when you apply that to, stocks and investing in the equities or fixed income markets, we have to look at, how things have performed over time. If we panic, you said earlier, timing the market. Timing the market is not a good thing. Time in the market is a good thing. Prepared planning so you can avoid panic. And selling equities in down markets is really, really selling at a loss, moving to cash for short-term safety. And the unintended consequence of that can be a potential shortfall in your available assets for retirement income. You're just sitting on the sidelines and you're missing out on it. So, you and I have the solution to that. We have a book that we've offered called Income Allocation over the years. And income allocation allows you to make sure your income's okay, no matter what the markets do. And then so the remainder of it, we can invest for the long time, buy and hold, invest for the long time, try not to time the market. Don't worry about all our eggs are in one basket and we got to get the heck out to cash, because we don't need cash. We've got money coming in our income plan, our income allocation plan.
Yeah, when you've got that plan in place, when you've optimized your portfolio for the time that you will need to utilize those dollars and for the purpose that you will utilize them for, you can stay calm, you can maintain your long-term financial focus, and certainly an experienced, qualified financial professional can help you craft that plan, structure that plan, implement and monitor that plan on an ongoing basis, taking some of the emotion out of the picture for you. Rick Durkee would certainly help put perspective on market conditions and take a look at your plan specifically. Pick up the phone, give a call, 800-491-6220. That's 800-491-6220. Or you can go online, cfpgroup.biz, cfpgroup.biz. Right down here in the bottom right-hand corner, by the way, the 6th Annual Retirement Planning Summit, a series of videos from a whole bunch of guest speakers on specific financial topics. Great educational information there. Go check out the website, cfpgroup.biz, or or if you'd like that individual review evaluation, the planning help and assistance, give Rick a call, 800-491-6220. And Rick, we often talk about this one in terms of procrastination, not being progress, not being proactive, not helping anyone, but the final emotion on this list, indecision. Indecision is essentially the same as procrastination, correct?
Yeah. Indecision, again, it goes back to not knowing when to get back in the market or if we want to get in at all. So we stay in cash, we do the ostrich in the sand, with our heads in the sand. And, we're trying to protect these assets because we know how important they are to have for reliable income streams in our retirement. But we're concerned about the market volatility and what's going on. Market volatility is driven by uncertainty. If it's uncertain times, we are probably very emotional at this point or any of the other points that we've discussed today. And so we make, these decisions, and then we have poor consequences. The biggest problem with indecision or procrastination is, first of all, that you didn't have the information to know when to go back in. You didn't know how to time it to go back in. But the consequence of this is that inflation decimates our dollars because they're not earning enough money if we stay in cash. And if we're staying in fixed income products and the fixed interest rates or 10-year treasury, for a benchmark example, is so low, we don't have any interest that we're earning. We're going backwards due to inflation. So that indecision can definitely cost us big money over time if we're just waiting to go back in, or we don't have a solution to go back in. If we have a solution, if there's a product out there that you may not be aware of that's new, that's been created because interest rates are so low and would be a bond alternative for you or a CD alternative, wouldn't you want to know about that? Wouldn't you want to have that alternative than staying in cash and losing money safely to inflation and your purchasing power being lost? So I definitely say that this is one that we should avoid that trap. We should review our asset allocation mix. We should talk to a financial professional because they do have solutions for times as they change. And boy, are we in a changing environment right now.
Certainly are. Again, Rick Durkee helps navigate that changing environment each and every day. The world around us is going to change. It's going to be wild and choppy and crazy and unpredictable. Our situation is going to change and evolve over time as well. You need a guide to help you navigate all of that. And Rick Durkee has guided so many savers and investors in and across Charleston and the Low Country. And if you need help and assistance, pick up the phone and give the Coastal Financial Planning Group a call. There's no downside for placing this call. There's no cost. There's no obligation. Just a resource to give you specific, direct answers to your questions and to help you address issues and concerns. 800-491-6220. That's 800-491-6220, 800-491-6220. Finally, Rick, as we are wrapping up, one of the things that I think does generate some emotion is our sense of competitiveness and gauging our results. And so a lot of times investors tend to have a buddy or a friend or a neighbor or a family member that they sort of compare their investment results and progress with, or we compare our investment results to the market indices, what we see on the news. Is it red or is it green? What am I doing compared to the market? How have my returns been compared to the S&P over the past year or 5 years? Neither one of those, I think, is a fair metric or measuring stick, Rick, because our results need to be based on our individual situation, not what others are doing, and certainly not what the market does. Because I may be, I may not want to take losses. I may be intolerant to risk. So if I'm not tolerant to taking a lot of risk, comparing myself to the market would not be a fair assessment.
No, you should set your expectations accordingly. If you have less propensity for risk, then you have to understand that you'll want to accept less reward. So when we're looking at this from a standpoint of making these decisions, let's go back to what we opened up the show with, Peter, because it'll help accentuate the point you just made. Everyone's situation is individual. Benchmark indexes are based on portfolios that most people don't have to compare to in their individual investments. And No one's plan is the same. It's what keeps us happy at the Coastal Financial Planning Group every day is everybody that comes in has different goals and objectives. So it's putting a new puzzle together every time to create that ultimate outcome of what people want and need their money to do for them. And also, I want to give them that one emotion that we didn't talk about today, which is happiness. All right. In retirement, you should be happy, you should be stress-free, and you also should be having fun. Why are you worrying about your investments? You did what you had to do. You worked hard during your working years. Now let's let your money do the work for you while you're in your retirement years. And you can do that easily with a financial plan for retirement, a retirement income plan, and an income allocation plan.
Give Rick Durkee a call if you need help putting any of that together. He did mention that book, Income Allocation. If you would like a copy of that, you can request it from the website or by placing that call, 800-491-6220. That's 800-491-6220. That is a reference resource that is being used across the country by advisors, by savers and investors who are looking to understand the risks that we face in retirement and how to specifically structure the assets to help address those risks, minimize them, or eliminate them from being factors in our retirement. And if you'd like a copy of that essential retirement planning strategy guide, pick up the phone, give a call. If you would like to sit down with Rick and the team there at Coastal Financial Planning Group, give a call, 800-491-6220, 800-491-6220, and we'll talk to Rick Durkee next time here on Navigating Retirement, and we're looking forward to talking with you soon.
Hey, Peter, thank you again. And thank you everybody for joining us. And I want to throw out one more thing. Why don't you get the income allocation book today when you visit the website? Because in 30 days, we're going to have a class available to you online and you'll be all studied up for our class, Income Allocation, coming out in 30 days. Visit the website, cfpgroup.biz, and join us again next week for Navigating Retirement.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.